In today's Spotlight, we take a look at expectations for 2026 returns. We've titled this Managing Expectations because forecasting anything over a short period of time is always difficult, and using those short-term forecasts requires caution. What you'll see here on the first slide are the expectations for 2026 using Bloomberg consensus. Here we take today's price and the 12-month target from Bloomberg, and the result is the return that gets to that target price. The chart shows fixed income in the mid-single digits and equities with a range of 10 to 25% for next year, depending on the market. If some of those equity returns seem high, they are, to be honest. So as we transition to our next slide, we take a look at accuracy. The blue bar is what's called the standard error, which is the average amount that the expectations were off based on the actual return for the year versus that consensus estimate. Between 2009 and 2024, estimates were off anywhere from 4 to 7%, depending on the market. That's frankly not too bad for a short-term projection. However, averages are always dangerous, especially when you are looking at short-term returns. The red and white bars help to frame this danger. The red bar is the largest underperformance, and the white bar is the largest outperformance for a market versus expectations in a given year. For instance, U.S. large cap performed nearly 36% worse, or more than 27% better than the expectations in some of those years between 09 and 24. So there certainly is a positive to this as well as a negative, but the range is just massive. The point of this is just to say, manage your expectations, particularly when looking at short-term projections, because things change rapidly. Thank you for your time today.